Trade organization.
Well, JSW Steel has reported good set of numbers for the December quarter ended. EBITDA performance seemed to be in line with what the street was estimating. Profitability of the company has dipped as much as 7%, weighed down by the interest costs and depreciation, but that again was pretty much in line with what the street was estimating. Well, joining to take the discussion forward is the Joint Managing Director of the company, Seshagiri Rao. Hello and welcome to Bloomberg Quint, sir. I'm directly going to start off by asking you, the company this time around for FY19 is expecting to fall short of the sales volume guidance by as much as 2-3%. I'd like to understand what explains this miss.
If you really see production side, we are, as per the guidance, we have given the guidance of 16.75 million tons. Cumulatively for 9 months, we have done 12.52 million tons. So if we do 4.2 million tons, which average we are doing, so we'll be able to achieve 100% of our guidance in terms of production. As regards to sales for 9 months, we have done 11.47 million tons. We have given the guidance of 16 million tons. So if we have to do in this quarter 4.5 million ton sales to achieve our guidance. That means whatever we are producing in this quarter, we have to sell and also reduce the full inventory that got accumulated in the Q3. That is why we are cautioning, even though we are making every effort that we will reach our guidance. But in case we are not able to reduce this inventory, what is there, then there could be a slippage to the extent of 2 to 3%. But if I really analyze the numbers up to Q3, even including specifically Q3, the exports which were there in the last year and average 26%. In this year for 9 months, it is 13%. So there is half of what it was in the previous year. In this quarter, if I really look at it, it has fallen by 70%. We came down as low as 10%. Because starting from November, global situation completely changed. Sentiment is changed and weak demand and also prices have dropped. That is why export volumes were not on the expected lines in this quarter. So that is the reason why you find our overall sales volumes are lower than what we generally do. But domestic side, we have done extremely well. Domestic sales went up by 15% for 3 months, and for 9 months it went up by 17%. Our market share went up to 13.7% as against 12.9%.
Sure.
We have consolidated our position. Auto sales went up by 23%. Branded sales went up by 9%, and our retail sales went up by 3%. So there is extraordinary performance as regards to our domestic sales. So because export sales we could not do to the extent which we wanted to do, there is an accumulation of inventory to the extent of 3 lakh tons. So in this quarter, we will make all efforts to reduce the inventory and also sell whatever we are producing. If we can do that, then we will achieve full guidance of this year for sales also. In case there is any shortfall, that is only to the extent of unwinding of inventory. Otherwise, whatever we are producing, we will sell in Q4.
All right, sir. I'm going to start off by asking you a little bit also about the input cost pressures and also the efforts that the company is going to take here on to reduce them. Because NMDC has slashed the rate at least 4 times in the last 3 months. The company has now commissioned a commercial coke plant at Dolvi. What kind of saving is the company now looking forward with these 2 factors coming into play, and overall in Q4 as well as for FY20?
Iron ore mines which we have got in the auction, we have already commissioned 3 mines. These 3 mines total together we can get 1.8 to 2 million tons. There are another 3 mines which we have got in the auction. We are working on commissioning them. If not in this year, next year we will get commissioned. With that, total captive iron ore will be close to 5 million ton, which can go up to 6.5 million ton over a period of time gradually. So that may not reduce our cost of production, but it gives us reliability of getting iron ore next door in Karnataka. We will be able to reduce our cost of transportation of this iron ore to our plant. That is one big advantage we get. We also commissioned our pipe conveyor, which will reduce the cost of transportation. That is getting fully commissioned in this financial year, the full benefit of which will come in the next year. This is the second. Third is we have commissioned our coke oven plant, which is 0.75 million ton. We have declared commercial production from 1st of November. The second battery of another 0.75 million ton, we have started trial runs. So we'll declare, this is also ramping up production. This total together is 1.5 million ton of total coke, which we are buying in the market close to 1 million ton per year in the last year. Bought out coke and captive coke, the difference is between 4,000 to 5,000 rupees per ton. So that is a kind of reduction on this 1 million ton of coke, which can become a cost saving for JSW Steel in the next financial year, part of which will come in the Q4. This is the second area. Product mix side, we have commissioned our tin plate at Vasind. Now it is ramping up, so it is a 250,000 ton capacity per annum. As you know, the tin plate will have incremental EBITDA contribution over HR. So that is again adds to the bottom line as regards to this improvement in product mix.
How much incrementally EBITDA are we looking at?
Tin plate is 8 to 10,000 rupees incrementally EBITDA can come.
All right. Sir, I'm also going to be chatting a little bit about the turnaround strategy for Monnet Ispat, given you're expecting it in the timeline of 2 years. And also, I'd like to touch base about the two entities, one Ohio and the Italy unit, which until now are still loss-making on EBITDA level. Right. I'd like to understand when is the company estimating these two entities to turn around completely, at least on the EBITDA level coming through?
Monnet, as you know, there is a lot of improvement after we took over in September 2018. So we started operating the DRI plant, which was below capacity. Now it is working at 100% capacity of 0.5 million ton. So we are selling DRI and making EBITDA margins there. Similarly, pellet plant, which was closed, so we have recommissioned that plant. It is a 2 million ton plant. So it is operating at 1.2 million ton, and it requires some spares to increase it to 2 million and thereafter to 2.5 million ton. So that is working at 1.2. I think in the next few months it will go to 2 and next 2.5 million ton. That also will get completed very quickly. Then the next focus for us is to commission the next phase, which was not working, which was got closed. That is center plant, blast furnace, and electric arc furnace, and the bar mill. This we have commissioned in this just last week. So this is now working. So that will start contributing the cash flow. Then the incomplete projects, that is second EAF and the plate mill. This is we have to complete that project. So we will do it. That also will get commissioned in the next financial year. Then whatever we wanted to do, it gets completed. Then ramping up and starting turning around. That's why we have kept a 2-year time frame to complete all this whatever I just explained, and then start earning real EBITDA in the company of Monnet.
So break-even for Italy and Ohio is also expected to happen in the next 2 years by FY20 along with Monnet Ispat.
Monnet Ispat is an independent of what other two stories are concerned. In the case of Mingo, in our view, next financial year itself, this company can become EBITDA positive. Same story even in Italy. Now, after we took over, then we already commissioned the electric arc furnace and the melt shop, and the hot strip mill is working already in Mingo Junction. So it is a ramp-up phase now. So next year it should make money. Similarly, in Italy, we already started operating the rail mill to full capacity we are working on. Similarly, wire rod mill and the bar mill we have just commissioned. So these three together, I think next year, definitely it will add to the bottom line.
All right. I'm going to quickly chat a little bit about steel prices because POSCO apparently has given a very upbeat commentary coming in on steel prices. They expect the Chinese steel prices to perk up and rebound with the start of the Spring Festival, which is this month itself. With this in background, do you also expect steel prices to go up, given that now they're around in Jan, they were at a year low level?
The price drop for steel, which has happened in the last 2 to 3 months, is very, very steep, because everybody expected that the prices continue to drop. That is why the sentiment was not to buy. Destocking, these are the story which has unfolded starting from November. But in the last few days, there is an incident which has happened in Brazil, so that triggered the iron ore prices to go up from $70–75 to close to $90 per ton. Then coking coal prices also started looking up. So scrap prices went up. So all these three together keeps the cost of production for steel companies at a very elevated levels.
Right.
So that has triggered again a price hike in the steel.
Right.
So across the regions, we are seeing a $40 increase in the steel prices in the last few days. And the Chinese New Year, again generally sluggish during that time. So once they come back after 11th, we expect demand also to pick up. That is why the commentary across the steel industry we are seeing a positive price outlook going forward because of these events of higher raw material prices and the Chinese coming back and the Chinese stimulus. These are the reasons why everybody is reasonably okay for the next financial year.
Okay, so then FY20, what's your outlook for steel prices? What's the level that you are expecting, and what kind of incremental growth is it as compared to the financial year that we saw previously?
Steel price downside we don't expect from here because of the reasons which I just explained. As regards to India, it follows domestic landed cost of the steel.
Right.
So the prices already bottomed out. That's why we have increased the price 1st of February in the domestic market, considering the landed cost of imports. And the domestic demand is quite good. You must have seen the numbers of January, it is over 9%. And in the first 9 months of the year, it is over 7.9%. Right. And in the Q3, it is 8.1%. So demand was very, very strong in India. So next year, even some slowdown from auto sector. Considering that slowdown also, the demand is expected to be in the region of 7.5%. So the steel demand in India is reasonably okay. And international prices are expected to be better than what they are today. The landed cost of imports will go up. Therefore, we feel a good time.
So what's the level that we can work with for FY20?
Level is, today it is almost close to $520 per ton.
Right.
So I don't expect prices to come down below that. If at all, it has to go up.
So $520 per ton is what you expect minimum. All right. Okay. I'm going to quickly chat about the much sought after issue, which is Bhushan Power and Steel, where the recent judgment has come in, where the NCLAT has allowed JSW revised bid of around, I believe, 19,300 crore for the company. It also has suggested that, the appellate body has said that the lenders have the right to negotiate better terms. Would that mean that if the contenders go ahead and up the prices for the bids for the company Bhushan Power, JSW Steel also would do the same?
No, the point is here, NCLAT has given opportunity to almost all the resolution applicants to improve their financial offers, and they have given time. And all the resolution applicants have submitted their revised offers. They have been evaluated, and NCLAT has asked the COC to put the result of their evaluation in a sealed cover and give it to NCLAT, which has been done. So NCLAT has given their judgment now, saying that the contentions given by the opposite parties are not tenable legally.
Right.
And they said JSW Steel resolution plan, which has been approved by COC, can be submitted to NCLT now for adjudication. So that is the stage where the litigation is there today. And if we receive the LOI, and COC decides to submit to NCLT, and NCLT approves without any further litigations, and we are ready to implement and go ahead.
So right now you feel there is no scope of further negotiation coming in from the lenders in terms of revision of the bids. My question to you is, if there is this scope of revision, would the company be interested to go ahead and revise the bid for the company?
We have already given an offer. So when we sit on the table, always there are some points which we have to discuss. So that discussion would continue to happen with the successful bidder. So that process will always be there in any kind of finalization of the bids.
That was quite a chase, I would say. I would also want to ask a little bit about the synergies coming in from Bhushan Power and Steel, specifically geographically and also product mix for JSW Steel. How important is Bhushan Power and Steel? And also with the given present capacity that Bhushan Power and Steel has, what capacity can it further be ramped up to once JSW Steel acquires this asset?
No, it is an interesting asset for us because we are not present on the east of India. So it is located in Orissa state, which is rich in minerals.
Right.
Demand is also growing in that region. So therefore, we would like to be present in that, either through acquisitions or through greenfield. We are working on the greenfield project. We will do in the medium term work on the greenfield project. In the meantime, if we eventually get this asset, and we will work on definitely to improve the capacity utilization to the installed capacity of around 3 million ton. Thereafter, we also explore possibilities of increasing the capacity.
All right. I'm then last going to ask you a little bit about your operating leverage right now. I believe the capital requirement for Dolvi and Vijayanagar is estimated, it's perceived to be around that 43,000 odd crore, which is spread across FY19 to FY21. Would this acquisition of Bhushan Power and Steel in any way not strain your balance sheet, especially your, your net debt to EBITDA level, which is now at 2.3 times on consolidated basis? Would that not have a strain on the balance sheet?
We have been guiding the market since several years that we wanted to keep our debt to EBITDA at 3.75. We are well within that. Today we are at 2.32. So there is enough headroom, including either organic or inorganic growth, which will happen in the company, that we will live within this 3.75 levels.
All right, that's all that we have for you in that case. Thank you so much for talking to Bloomberg Quint.
Thank you. Thank you.